Perfect. So we will begin the session. Very good morning to one and all present here today. On behalf of everybody at Sharjah Media City Shams, I would like to wish you all Ramadan Mubarak. I wish you and your family a safe and blessed holy month. My name is Shubhang Bhattacharya. I am the Marketing and Communications Manager of Customer Service at Sharjah Media City Shams, and I will be your host for today. Before we begin today's session, allow me a moment to take you through some ground rules. I would like to request everybody to keep themselves on mute throughout the session. Should you have any questions during the presentation, please use the chat option to type them in. At the end of the session, I will be putting your questions to the panelists. Please note that most of the information available on this topic will be covered in the presentation today. So I would urge you to wait till the presentation has concluded to type in your questions. This session is divided into two segments. The first segment will be the presentation, taking you through the various aspects of the law. This will be followed by the next session where we will be asking our panelists for their thoughts on certain aspects related to corporate tax, followed by your questions. With that, let's begin the session. Today's Shams Talks is about corporate tax in the UAE. It highlights and implications. Since the announcement on 31st January 2022, there have been a lot of speculation on what this law will mean for companies within the UAE and how it will impact us. Although this is an ongoing process and a final set of regulations surrounding this are yet to be released, today, we have invited a panel of experts to take you through what we know so far and what we can expect in the months to come. First on our panel today is Mr. Nilesh Usher. Nilesh Usher is a tax partner with KPMG based in Dubai with over 24 years of Big Four international and M&A experience advising clients across the Middle East, India, UK, and Europe, and has been based in Dubai since 2012, where he was previously leading KPMG's tax practice in UAE, and more recently set up and led a tax boutique firm in the Middle East. He is joined by Mr. Sameep Uchal. Sameep Uchal is a tax director with KPMG based in Dubai with about 10 years of Big Four international and M&A tax experience, advising clients across Middle East, India, US, and Canada. Prior to KPMG, Sameep was a part of the M&A tax practice for another Big Four in India and also set up their international M&A tax desk in New York. Next, we have Mr. Rajaram Dorairaj. Mr. Rajaram is the managing partner of A&A Associates and SNR Associates. He's having over 25 years of experience in auditing, business advisory services, startups, mergers and acquisitions, and organizational consultancy. And finally, we have Mr. Mohammed Syed from Creative Zone Tax and Accounting. Mohammed Syed is an honored tax registered agent accredited by the Federal Tax Authority, holding high degree of training and accuracy in administrative, legal, and practical elements of tax. His expertise of tax and company law contribute towards assisting his clients in public as well as private sectors. With that, we begin today's session. I would like to now hand over to Nilesh and Sameep to take you through their presentation. Thank you.
Thanks, Shubham, and good morning, everyone. Thank you for the opportunity to present on the UAE corporate tax developments. This is Nilesh Usher, and I will run through, along with my colleague Sameep, run through some of the developments and the announcements, but importantly, also talk a bit about what are some of the issues that are likely to be relevant for businesses operating in the UAE and in particular in the free zones, and therefore what level of preparation does businesses need to carry out in advance of the implementation of the law. As you all may be aware, the announcements on UAE federal corporate tax was made on the 31st of January 2022. Earlier this year. And this was, for those of you that are following the global developments on international tax, there is the OECD's proposals on BEPS 2.0 and in particular Pillar 2 or Global Minimum Tax as it's called, has now been issued and finalized. And UAE is a signatory to these global proposals. And what these global proposals essentially require is, they say that large multinational groups that are of a particular size, if they are operating in multiple jurisdictions, then these large groups must pay a minimum level of corporate tax at the rate of at least 15% in every jurisdiction in which they operate. Now, obviously, UAE in the past has not had a corporate tax system other than for certain oil and gas operations and branches of foreign banks. But as you can imagine, that once these proposals are implemented, if UAE had not introduced or does not introduce a corporate tax, essentially these large multinational groups that are required to pay a 15% tax in each jurisdiction, if UAE did not exercise its right to tax these businesses, then they would be taxed elsewhere in other jurisdictions, and UAE would lose the right to the revenues, tax revenues, which would otherwise get paid in any case by these businesses in other countries. So that really has been the catalyst to the introduction of corporate tax. What we have at the moment is an announcement from the Ministry of Finance and a few frequently asked questions or FAQs that give us directional input into what the law is likely to look like when it is implemented. The actual law itself, the corporate tax law, is not yet released. That is expected to take place, that is expected to be released in the middle of the year, so mid-2022, we think sometime probably at the end of June or perhaps just before the summer. But the middle of 22 is when we expect the corporate tax law to be announced or to be released. Looking at some of the, what I'll do now is request my colleague Sameep to run through some of the highlights of the corporate tax law, and in particular, the impact on companies that are in free zones, such as yourselves, that are located in Shams. What could be some of the impact for companies operating in free zones? I'll come back and talk through some of the other issues in a few minutes.
Thanks, Nilesh. So in terms of what's out, so like Nilesh mentioned, there are certain frequently asked questions released along with the corporate tax announcement in Jan. The first and foremost, in terms of the effective date, it says that for financial years starting on or after 1st June of 23. So therefore, typically most companies that have a December year end, your first corporate tax year, the first year of applicability will be 1st of Jan 24 to 31st of December 24, and compliances and return filings may only be in mid 25. If somebody has a June year end, which may be in the minority, in that case, 1st of July 23 is when it may apply, and not 24. So therefore, for year ended December, companies 1st Jan 24, which is at least about 20 months out, is when it will start applying. In terms of the rates, like most of you must have seen, there are three buckets. Taxable income. When we say taxable income, is the adjusted taxable profits, the adjustments of which are awaited. To the extent it's below 375,000 dirhams, it will be zero rated. Anything above 375 dirhams, that's 375,000 dirhams, is expected to be taxed at 9%. So if there's a 400,000 or a 500,000 dirham income based on the adjustment, only the differential above 375,000 dirhams is expected to be taxed at 9% and not the whole thing. There is a third bucket, which kind of emanates from the global developments, which essentially says that groups at a consolidated level having a turnover of more than 750 million euros, those groups are required to pay a minimum tax at 15% in all the jurisdictions they operate. So what the UAE corporate law is expected to include, and they've already made an announcement through the FAQs, is that these groups, even if the UAE entity is well below that threshold, but if it's part of a multinational group that is subject to those global provisions, the 9% rate may not apply in that case, and a corporate tax of 15% may apply in that case. So therefore, there are three buckets. 0% for below AED 375,000, 9% on a differential above that. Specific groups or larger groups which have a consolidated turnover of more than 750 million euros or 3.15 billion dirhams, a 15% rate may apply. In terms of in-scope taxable persons, it seems that the main criteria is expected to be a trade license. So to the extent that a UAE entity or a UAE business has a trade license, we expect it to be in scope for corporate tax purposes. In terms of exemptions, currently they've exempted only natural resources and oil and gas companies who are already paying an emirate level corporate tax even before the introduction of UAE corporate tax. They are the only people who are exempt and out of scope for corporate tax. We'll come to free zones in a second. But in terms of individuals, individual income like salary or huge regular individual income is not expected to be in scope. However, if the individual carries on a trade in his own name or through a proprietorship concern or through a trade license where they're carrying out a business, we are expecting that to be within scope for corporate tax purposes. So just to summarize, any entity with a trade license or any individual carrying out a business through a trade license, they should be in scope for corporate tax. I think the most important question, which probably everyone on this call might have on their mind, is free zones. Historically, and most free zones operated under the premise that it will not be subject to taxes, particularly income tax. Suddenly, we have the introduction of corporate tax. So entities in the free zone may come up and say, there was a promise given to us and now what happened? It is the government's intent to partially continue the promise. So free zone entities, whilst in scope, are still expected to be exempt to the extent they comply with two conditions. One is all the regulatory requirements in terms of filings, legal considerations should be in check. Second, and most importantly, they should not conduct any business with mainland UAE customers. Now, the whole genesis for free zones in the country were to promote international trade. And I think it was a tolerated practice that free zone entities that undertook mainland UAE sales, there was no real law to enforce or penalize such companies. Now what the corporate tax law is saying that you can continue the exemption. You may not pay tax on your profits specifically for free zone entities, as long as all your income is derived from either outside the UAE or within the free zone. So in your case, in the entities in Shams, presuming that all the income is derived from free zone companies or outside the UAE, the free zone exemption will continue. And the exemption is not automatic. We are expecting the law to clarify that free zone entities will need to register and file corporate tax returns. What's an additional point that may be relevant to note is the FAQs have not clarified whether the free zone exemption denial, in case business with mainland UAE is undertaken, is it an all or nothing or is it proportionate? So let's say you have a total of 500 dirhams of income, out of which only 50 dirhams is from mainland UAE and 450 is either within the free zone or outside. Then is only 50 taxed at the corporate tax rate or is everything taxed? The law is not out as yet, but there is a possibility that it may be an all or nothing, where even a single dirham of income from mainland UAE could taint the entire exemption. We've also included some examples and illustrations in the next slides, and we can go through that in detail. In terms of exemptions, other exemptions that are also discussed in the FAQs, dividends and capital gains earned by UAE businesses from qualifying shareholdings are expected to be exempt. They haven't defined qualifying shareholding, but we expect this to be in line with some of the UAE, Europe, EU participation exemption regimes, where the shareholding threshold is between 5 to 10% and the period of holding is about a year. To the extent those conditions are met, it should be fine. We do not expect any source-based taxation in the UAE for foreign investors, unlike countries like India and China, where a foreign investor earning dividends or capital gains from UAE shares are taxed. UAE will not tax any foreign investors' income in the UAE. We are also expecting certain intra-group transactions. I'll discuss grouping in a bit, but there is a provision that's going to be included in the law for companies to be corporate tax grouped. The corporate tax grouping is expected to be different from the VAT grouping, but nevertheless the same concept. They can, based on certain conditions, certain entities can choose to form a corporate tax group. If the conditions are met, intra-group transactions and reorganizations within the group may be disregarded for corporate tax purposes. Since we're talking about grouping, we are expecting a corporate tax group to essentially be permitted under the law. What are the conditions to form a corporate tax group is still to be seen. It's possible that the law may provide a fairly high threshold in terms of legal and beneficial ownership being common to the extent of maybe above 90%. Those entities can form a corporate tax group. Detail is awaited, but generally we think that's where the law might say, to the extent that not just legal or beneficial, it might be legal and beneficial. So to the extent that there are nominee shareholdings, we'll need to review whether they can form a corporate tax group or not. Once a corporate tax group is formed, essentially that might help a loss-making entity use those losses to set off profits of another entity in the group, thereby work on the effective tax rate of the group as a whole. Potentially, once a corporate tax group is formed and permitted, different entities may not need to file individual tax returns. One tax return will go. But whether each entity needs to file standalone financial statements along with this corporate tax return, that's to be seen. And lastly, we are expecting the corporate tax group to likely be different from a VAT group. So it's very possible that there are certain entities which may be forming a VAT group, and therefore, from a VAT perspective, the transaction may be disregarded, but they might not necessarily qualify to form a part of a corporate tax group. So therefore, that's something which we'll need to wait and watch under law, and each company will need to assess how does the grouping impact them, both from a corporate tax and a VAT standpoint. We're expecting the computations to be rather simple, not very complicated, to the extent that there are business expenses, they'll be deductible, the usual suspects in terms of depreciation being allowed, amortizations, provisions and bad debts, the regular stuff that's there in most parts of the world. We're not expecting to be overly complex to start with. The FAQ has already clarified that there's going to be no withholding tax on any kind of payments from UAE, whether within UAE or cross-border. So that's another very positive piece where you may not need to assess withholding tax implications like some other parts of the world on every payment you make. There will not be any periodic payment of taxes during the year in terms of advanced tax or self-assessment tax. We're expecting taxes to be paid only at the time of filing returns once the taxes are completed. So all of this signals to the fact that it's going to be a rather simplified, friendly regime without too many complications. One critical part that we're expecting to kick in, and it's again in line with the global developments, is that once corporate tax kicks in, intercompany transactions, potentially even domestic, will need to be undertaken at arm's length in line with transfer pricing principles. So today, because taxes did not exist and there was no corporate tax regime, either companies did not even cross-charge for certain intercompany services provided, or intercompany payments were made without potentially benchmarking them to be at arm's length. That is one big thing that will change once corporate tax comes in, and that's something companies should already start thinking about. And lastly, Federal Tax Authority is expected to be responsible for all the administration and enforcement of the law. The rules are expected to come out probably, like Nilesh mentioned, mid-year in the next 2 or 3 months. So these are essentially the highlights of what's already published by the Federal Tax Authority as a part of the FAQs. We've also included some illustrations specifically for free zones because that impacts shams. So essentially what this slide seeks to achieve is that probably explain in a little more detail on what some of the different considerations can be in terms of how the free zone exemption may impact some transactions and may not impact some transactions. So just to take an example, there is a free zone company one. It undertakes transactions with a rest of the world company which is outside the UAE. or it undertakes a transaction with a company in the same free zone, that should be entirely exempt. That's what, and presuming the regulatory compliances are met, these transactions should be entirely exempt from corporate tax in the UAE based on the law. However, if the free zone company one undertakes a transaction with a free zone company in another free zone, there is no clarification at the moment. There is a possibility this may also be exempt, but the FAQs have not clearly spelled it out. So this is something we need to see. So essentially, the first simulation was what is fully exempt, anything that's outside UAE or within, say, Shams, for example. Let's say a Shams entity undertakes a transaction with an entity in Jebel Ali. Whether it's exempt or not, we'll have to see. Possibly it may be exempt, but the law has not clarified it. And the third example is if the free zone company in Shams undertakes a transaction with mainland UAE customer, that is expected to be taxable. Now, if the third illustration comes into the picture, that taxability may potentially erode all of the other exemptions in, as explained in illustration 1 and 2, where transactions with the rest of the world, and therefore the question marks in terms of whether the entire income will be taxable if this one transaction with mainland UAE customer exists, or whether it's going to be proportional. That's not currently defined in the law. So therefore, in terms of what free zone companies are thinking, is probably the right time to start thinking on how these exemptions play out for the respective free zone companies, whether I need to relook at some of the structures, whether I need to probably rejig some of my contracts. Those are some critical points that we are having a discussion with free zone companies. Moving on to passive income exemptions. Now, this is the dividend piece that we were talking about. We've taken an example where you have a parent outside the UAE having an investment in a UAE holdco, and UAE holdco investing in two subsidiaries, subsidiary 1 and subsidiary 2 within the UAE. We are expecting, to the extent there's income from parent co in the UAE to the ultimate parent, to the extent the ultimate parent earns income from dividend, interest, or gains, based on the foreign investor exemption, that will not be taxed no matter what shareholding they own. To the extent the parent co owns a qualifying shareholding in subsidiary 2. Now, qualifying shareholding is not defined, but we're expecting it to be probably greater than 10%, up to, if it's more than 10%, you might fall for a qualifying shareholding. To the extent parent co has a qualifying shareholding in subsidiary 2, dividends and gains on the investment in subsidiary 2 is expected to be exempt. However, let's say the parent co has a 1% stake in subsidiary 1, and there is dividends flowing from subsidiary 1 to parent co, or parent co sells shares of subsidiary 1. Likely the qualifying shareholding test may not be met, and in such a case, whilst there is no separate tax rate at the moment based on the FAQs provided for capital gains and dividends, if qualifying shareholding tests are not met, we're expecting dividends and capital gains to be taxed at the same rate as corporate tax, which is 9% or 15%, depending on which side of the bucket you fall on. One more point, whilst I missed on the first one, ultimate parent will not be taxed on any passive income earned from the parent co. Any of these companies, parent co, subsidiary 1, subsidiary 2, making any payments in terms of dividends or any other types of payments, there will be no withholding tax in the UAE. So we thought that the free zone and the passive income exemptions merit an illustration, but and obviously we're not seeing the chat box. There are questions, we are happy to answer specific ones. But maybe I'll just pass it over to Nilesh to continue on some other global developments and what the companies are seeing right now.
Thanks, Avi. I think the related issue on free zones, besides the exemption, comes on account of those businesses that are set up in the free zone that are part of large multinational groups, which will be within the scope of the global minimum tax rules, which applies a corporate tax rate of 15%. So if you are a company in the free zone that is entitled to the exemption, but you also have another group company, let's say in the mainland, where you will, if you're part of the large multinational group, the tax rate, as we mentioned, that would apply is 15% and not 9%. In that case, while the free zone company will be, the company that's based in the free zone or in Shams will be exempt from corporate tax, but the company on mainland would pay a 15% tax, and therefore, on a simplistic blending, jurisdictional blending basis, the effective tax rate for the group in the UAE, let's say, is 7.5%, because applying a simple average between 15 and 0. What happens in that situation is that you have a top-up tax that will apply either in the UAE or in the location of the ultimate parent entity. And the top-up tax will apply at the differential rate between 15% and your current ETR for the UAE, which will be at 7.5% in this example. So the message here really is that if you are an entity which is within, in the UAE, which is within the scope of the global minimum tax rules, then notwithstanding that you have an exemption, or you may have an exemption from corporate tax under the UAE corporate tax rules, you may in any case be covered under the global minimum tax rules that will be in effect starting in 2023. And a top-up tax may well get collected and paid either in the UAE or in the home jurisdiction under the global minimum tax rules. So this is something that needs to be factored into your modeling exercise and your impact assessment exercise. So those groups that are in scope of these global rules, besides a corporate tax impact assessment, you also need to run the impact assessment from a global minimum tax rules perspective, as these two rules do interplay and have interdependencies with one another. What the UAE corporate tax announcements have include is also reference to formal transfer pricing rules that will be introduced under the UAE corporate tax based on OECD principles. And really what these rules will look to apply on is essentially any related party transactions between your company in the UAE and any UAE and non-UAE group companies will need to be on an arm's length basis. Now, historically, because there was no corporate tax in the UAE, any intercompany support provided by companies in the UAE, whether in free zone or outside the free zone, whether that there was any funding that may have been provided by UAE businesses to UAE or non-UAE businesses, or any other management or other support that may have been provided in the past, we really didn't care as much from a UAE tax standpoint. Obviously, the other countries where those charges or expenses would be made would need to consider the allowability of those expenses from a tax deduction standpoint. But from a UAE standpoint, we never really had a concern as to whether these transactions were on an arm's length basis or not. But under the UAE corporate tax rules, you do need to identify all your related party transactions between UAE and other UAE or non-UAE entities. Unless obviously the companies are entitled to a complete exemption in the UAE, then transfer pricing may be less relevant. But otherwise, you do need to identify all your intercompany transactions and then look to benchmark those transactions under OECD guidelines and principles to identify and apply the arm's length price to those intercompany transactions, and essentially pay tax on those transactions, pay tax on those arm's length price in the UAE, assuming you're either on mainland or you are a company that's in a free zone that is otherwise not entitled to the corporate tax exemption, because you may be conducting, for example, business on mainland, or if you may choose, if the regulations do apply, if you may choose to fall within the scope of UAE corporate tax and choose to elect to pay corporate tax under the UAE regime, which may well apply. And as part of transfer pricing compliance, you will also need to prepare transfer pricing related documentation which is the transfer pricing policies, the local files and the master files relevant to the UAE. And these documents may well need to be submitted either as part of your tax return or kept ready in the event the tax return is subject to an audit by the tax authorities. So some of the questions for deliberation and consideration as you prepare for corporate tax is obviously look at, as you know, we discussed earlier in this session, you will have the benefit of forming a corporate tax group where transactions between the corporate tax group may be disregarded. Now, the criteria for a corporate tax grouping is, are likely to be different from the conditions for forming a VAT group. So you may have, and we expect there to be a higher shareholding threshold percentage to be eligible to form a corporate tax group if you have more than one group entities in the UAE. And to the extent your corporate tax group is different from a VAT group, obviously you need to look at the impact of transactions which may be disregarded for corporate tax purposes but need to be accounted for VAT and vice versa. If you do have companies that are, if you are located both within the free zone and outside the free zone, your ability to form a tax group between a free zone entity that is otherwise eligible for a tax exemption and a non-free zone entity may be limited. Because obviously in the free zone, you will be claiming or looking to claim a corporate tax exemption. So unless you choose to forego the exemption, which we think may be there in the law, unless you choose to forego the free zone exemption and choose to pay corporate tax, you will not be able to form a tax group with a mainland entity. Now you might say, why would anyone look to forego your corporate tax exemption? And the reason for that would be if you're a company in the free zone that is otherwise incurring losses for tax purposes, you will not be able to form a tax group with a mainland company and offset those losses against profits of a mainland company, unless you choose for the free zone company to form part of the corporate tax group and elect to pay corporate tax, in which case you may then be eligible to form a corporate tax group. But this aspect does need to be confirmed once the legislation is announced in the middle of the year. You need to look at your P&L and see what expenses are either currently being incurred or can legitimately be charged to the business in order to earn expenses that are necessary and wholly and necessarily required in order to earn the income. So are you making an appropriate charge for salaries? Are you making an appropriate charge in the business for interest and other funding? And are other expenses appropriately charged to the business, which will help reduce your corporate tax base on which the tax liability applies? Obviously, deductible expenses are those which are incurred for the purposes of the business. So any expenses that you otherwise charge into your P&L that does not and cannot be justified as being incurred for the purposes of the business are likely to be disregarded and disallowed. We need to consider whether for those businesses that have a significant level of fixed assets on your balance sheet, you do need to consider whether there will be a different depreciation rate under the corporate tax law, or will the depreciation rate that you otherwise apply in preparing your statutory financial statements be allowed as a tax deduction. To the extent there are different depreciation rates under corporate tax law and those that you apply for your financial reporting purposes, that may give rise to deferred tax balances if there is a difference between the depreciation rates for book and for tax purposes. Applicability of GAR rules. So GAR refers to General Anti-Avoidance Rules. We think that there may well be some provision in the law when announced, which will include provisions to the effect that any arrangement or arrangements that any business puts in place or any restructuring that is done, which has the primary motive of avoiding tax under the corporate tax law, will be disregarded. So, if For those of you that may be looking to do any restructuring or planning to optimize or mitigate the impact of corporate tax, do consider the timing of that exercise, and also whether your any restructuring is is entirely tax driven, and in which case they may well be disregarded, or can you support these by any non-tax considerations, so that the GAR or the anti-avoidance rules do not impact and essentially negate the benefit of any restructuring or planning that you may carry out. We talked about transfer pricing regulations. So as part of getting ready for corporate tax, do look at your intercompany transactions. Look at whether your intercompany transactions are appropriately cross-charged based on an arm's length principle, both within the UAE and outside the UAE, as this is likely to be a key area of focus by the tax authorities. What we don't have at the moment is the computation provisions. All that we have is in the announcement is that the starting point for determining your tax P&L will be your book P&L. So your profit and loss, your profit as per your profit and loss statements will be a starting point, and then the adjustments to arrive at your taxable profits are expected to be minimal. Nevertheless, in absence of the law at the moment, it is worth probably looking at 2 or 3 scenarios as to what the likely deductions or allowability is going to be under the corporate tax law, perhaps looking at modeling some depreciation rates, looking at modeling intercompany transactions on an arm's length basis, looking at intercompany funding on an arm's length basis, to see whether, what your actual corporate tax liability or cash tax liability is expected to be, not just based on historic data, but also based on any forecast data for 2023 or 2024, depending on when corporate tax is likely to apply to your business based on your financial year end. Some of the administration aspects, for those of you that have more than one legal entity in the UAE, do consider whether you are eligible or likely to be eligible to form a corporate tax group. Do consider the pros and cons of forming a corporate tax group and its impact, if any, on any current VAT groups that you may have. You will then need to obviously plan for registering for corporate tax and filing corporate tax returns. And obviously the registration will happen before the tax year goes into effect, and then the timing of the first return will likely be at a few months after the year end. But essentially you do need to plan your resources and data and systems to deal with the administrative burden of dealing with and filing corporate tax returns and dealing with corporate tax filings and audits. And last but not the least, as we said, for those of you that are in scope of the BEPS 2.0 Pillar 2 or the global minimum tax proposals, do look at the interplay between a corporate tax liability and corporate tax planning that you may do versus what your impact will be from a global minimum tax perspective. Because if you do look to optimize your UAE corporate tax liability, but if that results in any case you being subject to the global minimum tax rules, then any optimization may well be negated if the global minimum tax rules apply to you. So those are some of the issues we have. Obviously each business is different and will have issues that may be relevant to that business that needs to be considered. Sorry, there's a final point on the need for consolidated audited financial statements. So today you may or may not be preparing audited financial statements for your business. Obviously, when you file tax returns, you may have to support the tax return with audited financial statements. So do need to consider audits for your entities which are otherwise not within where you are otherwise not conducting audits going forward, that may well be required on an annual basis. So just final slide before we move on to questions that you may have. Really, there are a number of work streams in order to get ready for corporate tax effective, 1st June 2023 or 23 or financial year starting thereafter. Look at your current corporate group structure in the UAE. Do you have too many entities in the UAE, or are all your entities performing a key function or a business and therefore need to continue to exist and operate? Look at your intra-company transactions, from a transfer pricing perspective. Look at the operating model that is, that applies to you in the UAE. Is the right revenue and cost being booked in the right entity from a supply chain or an operating model perspective? We talked about running a few scenarios to determine what your cash tax liability is expected to be. Obviously, once the law comes out, you will have a more definitive idea. But run some scenarios based on your current P&L and some assumptions to see what the potential liability at 9% or 15% could be for your business. Do you have the right internal controls and governance to deal with corporate tax filing? Does your data and systems, are they geared to give you the information that you will need in support of your corporate tax deductions or corporate tax revenues and P&L, to the extent they are different from statutory reporting purposes? We talked about related party transactions. Look at the, we've talked about transfer pricing and the need for there to be transfer pricing documentation to be applied. Look at the impact you may have on accounting and on VAT and technology. So there are a number of, for those of you that prepare financial statements from an accounting standpoint, now that we know that there will be a corporate tax law that will be introduced, does that require you to take account of any deferred tax balances and deferred tax accounting on the basis of the enactment or substantial enactment of a corporate tax law? Look at the impact on VAT, as we said, particularly from a grouping perspective. And those of you that rely on use of technology and tools to automate your VAT filings or your ESR filings, obviously corporate tax needs to be incorporated into those technology elements as well. For those of you in Shams that are conducting business with mainland, those that may have mainland customers or mainland distributors or mainland service providers, do consider whether that potentially taints your free zone exemption. This is probably the most relevant point for those of you attending this call that have businesses within Shams, and make sure that you're otherwise compliant with all the regulatory requirements that Shams has imposed, to be in compliance with the corporate tax exemption. Look at whether your income streams include any element of dividends and capital gains from shares, and if so, are you likely to meet the conditions for qualifying shareholdings where the dividends and capital gains are otherwise exempt from corporate tax? And this exemption applies notwithstanding whether you're in a free zone or not in a free zone. Look at group relief provisions. We talked about this. Look at whether you do need to form a corporate tax group with another free zone entity or with another mainland entity, and if so, will you be eligible, and what are the conditions that will apply? To the extent you have excessive foreign taxes credits on account of any foreign withholding taxes that you may suffer, those withholding taxes are creditable against a UAE corporate tax liability, but only to the extent you are not claiming a free zone exemption and looking to pay taxes on your income. Then any overseas taxes will be eligible for a credit against your UAE corporate tax liability. Look at the impact of carry forward of losses. So losses will be eligible to be carried forward and offset against future profits, but it's only those losses that are incurred from the first year when corporate tax applies to your business. So any current or past losses that you may be having are not eligible to be carried forward. So one of the things you might want to consider is whether, based on appropriate accounting and legal principles, are you able to consider deferring any expenses legitimately and supported by accounting and legal considerations? Are you able to defer any expenses that you incur or expenses that you account into the tax year so that you can get the benefit of those expenses against your taxable profits in the year when corporate tax applies to you? And really, the final point is that businesses in the UAE now need to make a number of disclosures and a number of filings, whether it's under VAT, country by country reporting, ESR, UBO filings, and now we will have corporate tax, and then those groups that are within scope of global minimum tax rules, you will also have another tax return due under the global rules. The point really is that a number of financial and non-financial information will now be submitted to the tax authorities. It is extremely important that there is, even though this information is submitted under different legislations, it's important that there is consistency in the nature of that disclosure and the nature of the facts that are disclosed to the authorities under different legislations, because it's the Federal Tax Authority that is now responsible for VAT, ESR, and also corporate tax going forward. And again, very important that there's someone that looks at all of this and does a read across on the consistency element under the different legislations for data that's submitted in the tax returns or submitted to the tax authorities. So with that, Shivang, I'll hand it back over to you for any questions that may be coming through from the audience.
Perfect. Thank you so much, Nilesh and Sameep, specifically for curating something that's more relevant to free zones. That's obviously something that the audience that has joined here is very keen to learn. While you're typing in your questions, I would now like to move on to the next segment where we put our questions to the other experts, Mr. Mohammed and Mr. Rajaram. So I would like to start with Mohammed Al Sayed. I wanted to understand from you that in your experience, what was this initial market response to this corporate tax announcement? And do you think that this was an anticipated move by companies in the UAE, or did it come as sort of a surprise?
Thank you, Shobhan. Actually, corporate tax in the UAE has been in discussion for several years, and there is already corporate tax in the GCC in Saudi and Qatar. While the news for sure has made waves after the announcement 31st of January, we think that the development shouldn't come as a surprise. And also this looks a practical and sensible approach to ensure that the companies in the UAE can comply with the anticipated new international tax rules.
Perfect. And what do you feel is the official stance on most such regulations being introduced in the UAE? Do you feel that other tax laws are on the horizon, especially given VAT and corporate tax? Do you feel others on the horizon?
Currently, we don't think there is another tax will be in discussion in the UAE. I think for the short term, there is nothing that would be announced.
Perfect. Thank you so much, Mohammed. I would like to now direct my questions to Mr. Rajaram. Mr. Rajaram, do you feel that this move will image as an investment hub? What impact do you think that this can have on FDI and other aspects?
Okay. Initially, the tax rate in UAE, it is lower than the global minimum. And the net profit up to 375,000 will be the zero rated only. Hence, it won't affect the SMEs and the startups. The corporate tax, together with the double tax treaty, the network, will make the UAE as a leading hub for a business and investment. The UAE corporate tax will be one of the lowest in the world and is still attractive for a FDI investment. And still, there is a no withholding tax on a dividend, interest, royalty, capital gain. Hence, UAE will be investment hub for the FDIs. Yes.
Perfect. And I'd like to ask you one more question: that do you feel that this law will have an impact on an investor's decision making process vis-a-vis a free zone versus mainland? Do you think this tax will affect that decision making process for future investors?
See, as we discussed earlier, it is a very low tax rate only. So what you are conducting business within the mainland, that part only it's a taxable. Apart from that, if you are doing any business with other countries, then it won't be any taxable. Against it won't affect the business. See, after the announcement of the tax, still we are getting a lot of inquiries for the in free zone.
Understood. Thank you so much, Mr. Rajaram. So we have a bunch of questions that are currently being asked on the chat, and if we have, I'm sure Sameep and Nilesh, you're able to see the chat screen. If there are any questions you feel that are relevant that you can answer, alternatively, Mr. Mohammed and Rajaram, if you have any questions that you feel that have clarity at this point.
Sure. So, Shubhang, I think the first question was from Prashant. If FZ code deals with ROW 80% and mainland 20%, is 100% taxable? Now, the law is not out, and therefore the FAQs have not explicitly clarified this, that whether only 20% is taxable or 100%. But there is a possibility that it could be an all or nothing, which means even if $1 of income, and it's not profits, even if $1 of income is from mainland customers, it could potentially taint your exemption. So at the moment, it might be prudent for companies to plan that it might be an all or nothing, where the 100% of profits may be taxable with any mainland.
There are obviously different models in which this situation applies, because you might have a company in free zone that only, for example, procures goods or services from mainland, but sells 100% of earns 100% of its revenues from the rest of the world. In that case, we think that obviously the exemption should continue, even though there is some mainland business in the sense on the purchase of the procurement side. But if on the revenue side, there is any income from mainland, we really have two options, which is the proportionate denial, obviously, of only the mainland income, or 100% denial of the free zone exemption altogether. And I think we need to be prepared for both situations. It's not absolutely clear that it will only be a proportionate denial. So businesses do need to look at this slightly carefully.
Perfect. We had a question from Siddharth, who's asking if a free zone company profit is below 375,000, will tax apply if the company is dealing with a mainland UAE based company?
I think the answer to that should be no. It should not, on the basis that it may have to still obviously free zone companies will have to still file a tax, register for taxes, and file a tax return. And I think in the tax return, it will have to, we think what might happen is in the tax return, it will have to set out its position, whether it's claiming a free zone exemption or whether it's saying it's not eligible to a free zone exemption and is subject to tax. But when it's subject to tax, because its profits are below 375,000 dirhams, it pays a 0% tax. But I think that position may well need to be set out in the tax return that will need to be filed.
Perfect. Thank you. And I think
Valdemar is a similar question by Robbie after that as well. So maybe we can skip that.
Yeah. A question from Akram: can income tax, zakar, or WHT paid in Saudi, Qatar, or Oman be credited to the income tax due on a company, whether it's in the free zone or mainland?
So what is likely to happen is, so firstly, it depends on who has paid the tax or zakat in Saudi, Qatar, or Oman. If it's the free zone company that has paid these taxes itself on any income that has been paid to it from Oman, Qatar, KSA, then that withholding tax will be creditable so long as the income is reported and offered to tax in the UAE. So if there's a 10% withholding tax, for example, that's applied by Qatar or by Oman, but the income is claimed as an exemption under the free zone regime, then that 10% withholding tax will be lost. If, on the other hand, the free zone company in the UAE decides that it is either not eligible for a free zone exemption or that it otherwise wants to elect to be part of the corporate tax regime, then on that income, it will choose to pay the tax, which is at the rate of 9%. But against that, it should be eligible to get a credit for the withholding tax paid in Oman or Saudi Arabia or Qatar. Obviously, zakat that is paid, I would imagine if that's paid by a group entity in Saudi Arabia, then that zakat is, even though that may be paid by the shareholders, it is unlikely that that will be eligible as a credit against UAE corporate tax liability.
Perfect. Thank you so much. A question from Ravinder. I think this might have been covered, but if are filing returns compulsory even if a company does not have a tax liability?
It's not explicitly set out in the announcements yet, but I would expect that all companies in the UAE that have a trade license will be required to register for corporate tax and file a corporate tax return, even if it has no tax liability or the income is below 375,000 dirhams, or if there is no income or is a dormant company. I think there will still be a requirement to file a tax return, unless obviously the law sets out any exemptions when it is introduced.
Perfect. So we do have 5 more minutes. No, 2 more minutes. If anybody has any questions, you may post them here. Alternatively, obviously this the session was live streamed on YouTube. So you will be able to catch, there are certain sections that you want to revisit, particularly relating to the free zone aspects of it, you can revisit those on the YouTube link and have a look for yourself. And if you have any further questions, you can place them in the chat option right now. We are open to taking questions for another minute. If you have anything, you can place them in the chat option. As I can see, we don't have anything. We don't have anything currently on the chat section vis-a-vis questions with regard to the presentation. Yes, Ravinder, the presentation is as was presented will be on YouTube, so that won't be an issue at all. I don't believe we will be sharing a soft copy of this presentation with anyone, but you can have access to the session via YouTube, so that won't be an issue. The session will be the same. I believe Prashant has a specific question. Sameep, if you can let me know if this is something that you can answer.
Right. So I think Prashant's question really pertains to tax grouping. And Prashant, what we understand is you have a Bahraini company where you are a 50% shareholder, and also you have a UAE company where you're a 100% shareholder. So to start with, the tax grouping provisions that we're talking about in the UAE corporate tax law is essentially between UAE companies. So a Bahraini company and a UAE company might not form a tax group under the UAE corporate tax law. Not sure if I understood facts, but what we think is 2 UAE companies potentially having common legal and beneficial ownership, and the threshold might be fairly high, 90 or 95%. To the extent that's the case, they can form a corporate tax group. But a foreign company and a UAE company may not be able to form a corporate tax group. and anyone with maybe a 50% shareholding in a UAE company and a 100% shareholding, also we think it might not form part of corporate tax.
Yeah, and if you look at the other countries which has introduced tax grouping rules, is generally companies within the same jurisdiction that are otherwise eligible to form a corporate tax group. It's unlikely that you will be able to form a corporate tax group between a UAE and a non-UAE entity. Because obviously, as you can imagine, the non-UAE entity is governed under tax laws of that relevant jurisdiction. And even though this may be Bahrain, which does not have a corporate tax system at the moment, UAE legislation from a sovereignty perspective will not have rights over non-UAE entities. So unlikely that you'll be able to form a tax group between non-UAE and UAE entities.
Perfect.
Well, I think
So,
the question that's come
we
up from Prashant is, when should we start preparing? I think while I can tell you that many businesses have already started looking at the potential impact of corporate tax, and I think while we don't have the law yet, we have, fairly, we have a fair amount of information on the key provisions, the key exemptions, and the key direction in which the tax law is likely to head. So I would suggest doing some preliminary assessment already and starting with that already now, and then obviously looking to refine and implement it once the law comes out. As I said, any planning or optimization that you may look to consider, you should probably look to do that before the law is announced. Obviously, we would recommend that any planning or optimization is done with the full, in full compliance with the tax law that the UAE will set out, and there should, you should not look at looking in place any arrangements or structures which are purely tax motivated. Do consider whether there can be a legitimate change in business model to optimize your tax profile. So on that level of discussion and planning can already start now and can be refined once the law is announced.
Perfect. So we do have a few questions from our YouTube stream as well, but the people who are viewing this on YouTube, your questions have been answered at the first half of the presentation. So if you could just go back to the first half of this presentation, you will be able to view the answers to your questions. Thank you everyone for joining in. Once again, I would like to extend a big thank you to our panel today, Mr. Nilesh Ashar and Sameep Uchul from KPMG, Mr. Rajaram Durairaj from ANA Associates, and Mohammed Sayed from Creative Zone Tax and Accounting. We were really grateful that you took time out of your schedules today to address us on this issue that this legislation that is on the horizon. We will be having more sessions as things become more clear. So stay tuned for more information on this topic, and we will be hosting more such webinars on compliance issues, tax and accounting, and other topics concerning the businesses. So at Shams, it is our endeavor to keep you updated with all the latest information that may impact your business. And with that, I would like to thank you all for joining once again, and special thanks to all our panelists. So thank you very much. I wish you a lovely day ahead. Thank you.
Thank you, Shubham. Thanks, everybody.
Thank you.